There is a single question that quietly terrorizes every investor, from the novice managing their first $1,000 to the seasoned fund manager overseeing billions. It's a ghost in the machine of the stock market, a nagging uncertainty that can curdle confidence into anxiety in the span of a single news alert. The question is this: what happens when the genius leaves? What happens when the visionary founder steps down, the turnaround artist retires, or the celebrity CEO is poached by a competitor? We are taught, almost culturally, to bet on the jockey, not the horse. We read the profiles of charismatic leaders, we listen to their conference calls, we buy into their vision, we invest in people. And in doing so, we introduce a catastrophic, single point of failure into our entire financial future. Our portfolio growth, our wealth management strategy, our dreams of financial freedom become tethered to the health, happiness, and continued employment of one single human being. This is the ultimate form of speculation, dressed up in the respectable clothes of business analysis. Warren Buffett, over a lifetime of beating the S&P 500 not by inches but by miles, has offered a radical and deeply liberating alternative. He has proposed a principle so simple it sounds almost insulting, yet so profound it forms the bedrock of his nine-figure-a-day fortune. The principle is this: buy a business that is so good, so fundamentally powerful, that any idiot can run it, because sooner or later one will. This is not a cynical joke. It is the single most important piece of risk management advice you will ever receive. It is a complete paradigm shift. It tells you to stop betting on the ever-changing, unpredictable, and often irrational world of human leadership, and start betting on the durable, structural, and near-permanent reality of a dominant business. It is the final promise an investment can make, that its success is inherent to its very nature, not dependent on the fleeting brilliance of the person in the corner office. The costly market mistake this prevents is the siren song of the turnaround story, the allure of the superstar CEO who promises to spin straw into gold. These are narratives that sell newsletters and generate headlines, but they are treacherous grounds for capital preservation. When the turnaround proves too complex, or when the superstar inevitably moves on, the investor is left holding shares in the same broken business that existed before, only now the hope has evaporated and the stock price follows. The financial transformation that occurs when you adopt this principle is one of profound peace of mind and relentless compounding. You stop chasing quarterly earnings whispers and start focusing your capital on businesses with unassailable competitive advantages, a brand that lives in the hearts of millions, a low-cost process that competitors cannot replicate, a network effect that grows stronger with every new customer. Your investment is no longer a fragile bet on a single person. It is a fortress, protected by the very structure of the business itself. Over the next hour, we are going to deconstruct this master principle. We will not just admire it. We will dissect it, reverse engineer it, and forge it into a tool that you can use for your own stock picking, for your own journey towards long-term investing success. We will explore the 5 pillars that hold up this powerful idea, transforming you from a speculator on CEOs to a true owner of indestructible businesses. Our first pillar is the very foundation of this entire philosophy, understanding the anatomy of an unassailable moat. Because before you can find a business an idiot can run, you must first understand what makes a business so powerful that it can withstand the occasional idiot at the helm. This isn't just about having a good product or a clever marketing campaign. It's about possessing a structural advantage so deep and so durable that it becomes a barrier, a deep, wide, alligator-filled moat that keeps competitors at bay and profits safely inside the castle walls. To truly grasp this, we must travel back to 1972. Warren Buffett and his partner Charlie Munger were presented with an opportunity that would forever change the DNA of Berkshire Hathaway. It wasn't a technology company, it wasn't a complex financial instrument, and it certainly wasn't a high-growth startup. It was a candy company, See's Candies. To the outside world, it looked quaint, perhaps even boring. A chain of candy shops based primarily in California, selling chocolates and brittles from old-fashioned recipes. They were being asked to pay $25 million for it. By conventional metrics of the day, it was a steep price. The company had only $8 million in tangible assets: the stores, the equipment, the inventory. The remaining $17 million was for something intangible, something you couldn't touch or quantify on a traditional balance sheet: goodwill, the brand. Most investors would have balked. They would have seen a $17 million premium for air for a name. But Buffett and Munger saw something else. They saw a moat as wide and deep as the Pacific Ocean, just miles from See's California stores. They sat down with the managers and began their investigation, not just into the numbers but into the soul of the business. They discovered that for decades, See's candies had become an integral part of the customer's life. It wasn't just a product, it was a tradition. People bought See's for Christmas, for Valentine's Day, for birthdays. When a young man went to meet his girlfriend's parents for the first time, he brought a box of See's. It was a social convention, a gesture of affection and quality. The brand was lodged in the customer's brain with an emotional glue that no amount of advertising from a competitor like Russell Stover could dissolve. This emotional connection gave See's something magical: pricing power. Buffett famously tells the story of how, year after year, they could raise the price of a box of chocolates on December 26th, and not a single customer would desert them. The cost of the raw ingredients, sugar, chocolate, nuts, would go up, and they would simply pass that cost on to the consumer, plus a little extra for themselves. The customers didn't care if the box cost $10 or $11. The emotional value of giving that specific, trusted brand of candy far outweighed the marginal increase in price. This was the moat. It wasn't a patent. It wasn't a secret formula. It was a psychological monopoly in the minds of its customers. Buffett and Munger paid the $25 million. Over the next several decades, See's candies would generate over $2 billion in pre-tax profit for Berkshire Hathaway, all while requiring very little additional capital investment. It was a money machine that ran on nostalgia and brand loyalty. The management didn't need to be visionary. They didn't need to invent new, disruptive forms of candy. They just needed to not mess it up. They needed to maintain the quality, keep the stores clean, and continue the traditions. An idiot could do it. And this single transaction became the foundational anecdote for Buffett's entire investment philosophy. It taught him that the best businesses weren't the ones with the most brilliant CEO or the hottest new technology. They were the ones that owned a small piece of their customer's mind. A piece that was, for all practical purposes, not for sale at any price. The power of the See's Candy story isn't just a quaint business tale, it's a masterclass in exploiting a fundamental quirk of human psychology. The underlying psychological principle at play is a powerful cognitive bias known as the affect heuristic. This heuristic is a mental shortcut our brains use to make decisions quickly and efficiently. Instead of performing a detailed, rational analysis of a situation, we often base our judgment on the emotion we feel in the moment. If something makes us feel good, we perceive it as having high benefit and low risk. If it makes us feel bad, we perceive it as low benefit and high risk. See's Candies, for its customers, was drenched in positive affect. The brand was associated with family, holidays, romance, and celebration. The black and white checkered stores, the free samples, the image of Mary C. on the box, all of these elements triggered a cascade of warm, positive emotions. When a customer stood in front of the candy counter deciding what to buy, they weren't performing a cost-benefit analysis of cocoa content versus price point. They were outsourcing their decision to a feeling. The feeling said, See's is safe, See's is quality, See's means I care. This emotional shortcut is incredibly difficult for a competitor to overcome. A new company could launch a massive advertising campaign. They could even offer a product that wins in a blind taste test, but they cannot easily replicate the decades of accumulated positive emotions stored in the customer's brain. To switch from See's to a cheaper brand isn't just a financial calculation for the consumer. It feels like a slight emotional downgrade. It feels a little cheap, a little less special. This is the moat. It's not built of bricks and mortar. It's built of neural pathways and dopamine hits. Buffett understood this on a gut level. He realized that a business that harnesses the affect heuristic creates a powerful form of customer inertia. The decision to buy becomes automatic, a habit passed down through generations. This is a crucial element for any entrepreneur or investor looking to build or identify a durable company. You are not just selling a product, you are selling a feeling. The stronger and more positive that feeling, the more pricing power you have and the less you need to worry about the competition. This principle also protects the business from managerial error. Imagine a new CEO at See's decides to cut costs by using slightly cheaper chocolate. The immediate financial statements might look better, but the subtle change in taste would ever so slightly disrupt the positive affect. It would create a tiny splinter of doubt in the customer's mind. Over time, those splinters accumulate, the emotional glue weakens, and the moat begins to drain. The genius of the See's model is that the best executive decision-making is often to do nothing at all. The prime directive is to protect the source of the positive affect. This is why an idiot can run it. The idiot's primary job is to not be a cost-cutting genius who outsmarts himself and destroys the intangible asset that generates all the cash. The psychological principle dictates that consistency and tradition are more valuable than innovation and disruption in a business like this. The retail investor who understands this can start to see the market differently. They stop looking for companies with the most exciting new product announcements and start looking for companies with the most boringly consistent customer love. They are looking for businesses whose competitive advantage is rooted in the irrational, emotional, and deeply human parts of our brains. So how do we translate this understanding of moats and psychology into a practical, repeatable process? How do we build an applied mental model, a blueprint, for identifying these idiot-proof businesses for our own portfolios? This is where we move from theory to action, creating a systematic approach to stock picking that focuses on durability over glamour. The blueprint consists of 4 distinct steps: the moat identification checklist, the pricing power test, the maintenance capital audit, and the idiot-proof management test. Step 1 is the moat identification checklist. You must become a detective of competitive advantages. There are 4 primary types of moats you should hunt for. First, intangible assets, like the brand power of See's candies or Coca-Cola, or a patent that gives a pharmaceutical company a temporary monopoly. Second, high switching costs. This is when it is too expensive, time-consuming, or just plain annoying for a customer to switch to a competitor. Think about your bank. Moving all your automatic payments and direct deposits is a massive headache, so you stick with your current bank even if a new one offers a slightly better interest rate. Enterprise software companies like Microsoft or Oracle are masters of this. Third, the network effect. This occurs when a product or service becomes more valuable as more people use it. Facebook, Visa, and MasterCard are classic examples. The more people who are on Facebook, the more valuable it is to you. The more merchants that accept Visa, the more useful the card is to a cardholder, and vice versa. This creates a powerful, self-reinforcing feedback loop. Fourth, a cost advantage. This is the ability to produce a product or service at a lower cost than competitors, allowing the company to either undercut on price or enjoy higher profit margins. Walmart's legendary supply chain and Geico's direct-to-consumer insurance model are prime examples. Your first task as an analyst is to look at a company and determine if it possesses one or more of these moats, and how strong they are. Step 2 is the pricing power test. This is the litmus test for a truly great moat. A company with a strong competitive advantage should be able to consistently raise its prices slightly faster than inflation without losing significant business. Look back at the company's financial history for the last 10 years. Has its revenue per unit or gross margin been steadily increasing? Read their annual reports. Does management talk about price increases with confidence? Think about it from your own perspective as a consumer. If the price of your Netflix subscription, your iPhone, or your Starbucks coffee went up by 5% tomorrow, would you stop buying it? If the answer is no, you are looking at a company with pricing power. This is the most direct evidence of a business that owns a piece of its customer's mind. Step 3 is the maintenance capital audit. An idiot-proof business shouldn't require constant massive injections of capital just to stay competitive. It should be a castle that defends itself, not one that needs constant, expensive repairs. You need to dive into the company's cash flow statement. Look for the line item capital expenditures. Compare this number to the company's depreciation expense. In a great, durable business, the amount of money needed to maintain its current operations, maintenance capex, is often a small fraction of its operating cash flow. These businesses are cash-gushing machines. They make so much money that after reinvesting what's necessary to keep the business humming, they have enormous piles of cash left over to buy back stock, pay dividends, or acquire other businesses. A business that has to spend every dollar it makes on upgrading factories or massive research and development just to tread water is a fragile, difficult business to run. It's not for idiots. Step 4 is the idiot-proof management test. This is a qualitative assessment. Read the last 5 years of shareholder letters. Is the language simple and clear, or is it filled with jargon and complex acronyms? Buffett and Munger believe that a business that requires a 150-page explanation is probably too complicated to be a truly great business. Is the management focused on long-term operational excellence, or are they constantly chasing the latest fad, restructuring and reimagining the future? Boring is beautiful. A management team that talks about widening the moat, delighting customers, and maintaining product quality is a green flag. A management team that talks about synergies, paradigm shifts, and disruptive innovation every quarter is a potential red flag. They might be geniuses, but the business might require that level of genius just to survive. By systematically applying these 4 steps, you move beyond simple stock tips and narratives. You begin to build a framework for quality investing that prioritizes business analysis over CEO analysis. You are building a portfolio designed for long-term growth and, most importantly, for sleeping well at night, knowing your capital is defended by moats, not men. To truly appreciate the wisdom of investing in a business an idiot can run, we must dedicate ourselves to studying the alternative. We must explore the antithesis, the path of the 99%, and understand why it so often leads to financial ruin. This is the world of hype, hope, and hero worship. It's the seductive allure of the turnaround story and the charismatic savior CEO, a narrative that the financial media loves to promote and that retail investors flock to, almost always to their own detriment. The 99% approach is built on a foundation of stories, not structures. It begins with a company that is fundamentally broken. Its margins are collapsing, its market share is eroding, its products are obsolete, the stock has been decimated, trading for a fraction of its former glory. Then the news hits. A new CEO is being brought in. He's a legend, a rock star, the turnaround artist who supposedly worked miracles at his last company. The narrative is intoxicating. This new leader will slash costs, streamline operations, innovate new products, and restore the company to its rightful place at the top. The stock price jumps on the news alone. Investors pile in, betting not on the broken business, but on the single individual who has promised to fix it. This is a gamble of epic proportions, and it fails for a few predictable, painful reasons. First, the base rate of success for corporate turnarounds is astronomically low. For every legendary comeback story like Apple under Steve Jobs, there are hundreds, if not thousands, of failures. Think of Sears under Eddie Lampert, a celebrated hedge fund manager who was supposed to be the next Buffett. He poured billions into the company, trying to transform the decaying retailer, but the fundamental business was too broken. The competitive landscape had shifted too dramatically. No amount of financial engineering could save it from the structural advantages of Amazon and Walmart. Investors who bet on Lampert's genius lost nearly everything. Second, the savior CEO is often a product of the halo effect. a powerful cognitive bias where our overall positive impression of a person in one area influences our judgment of them in another. A CEO who was successful in one industry, say software, is assumed to be a genius who can fix a company in a completely different industry, say manufacturing. But business skills are often not fungible. The dynamics of one industry are unique. The genius often finds himself in a new environment where his old playbook is useless. Ron Johnson's tenure at JCPenney is a textbook example. Johnson was the retail visionary behind Apple's wildly successful stores. He was hired to bring that same magic to the struggling department store chain. He immediately implemented a radical new strategy, eliminating discounts and coupons that were the lifeblood of JCPenney's customer base. The result was a catastrophe. Sales plummeted by over 25% in a single year, and the company was brought to the brink of bankruptcy. Johnson's genius in the world of premium electronics did not translate to the world of mid-priced department stores. He didn't understand the customer. He didn't respect the existing, albeit weak, business model. He was a jockey trying to ride a completely different kind of horse, and he fell off spectacularly. This path also ignores the immense, unseen forces of organizational inertia and cultural rot that plague struggling companies. A single CEO, no matter how brilliant, cannot single-handedly change the habits, processes, and morale of tens of thousands of employees overnight. They are fighting a war on 1,000 fronts against entrenched middle management, outdated systems, and a culture of defeat. The odds are stacked against them. The 99% investor ignores these odds. They buy the story. They fall in love with the leader. Their asset allocation becomes a lottery ticket on one person's ability to defy gravity. In contrast, the Buffett-style investor looks at a turnaround situation and sees a, quote, witnessness that is hard. They see a moat that has been breached and a castle that is already on fire. They know that trying to fix it is a low-probability, high-stress endeavor. They would rather pay a fair price for a wonderful business that requires no fixing than a cheap price for a broken business that requires a miracle worker. This discipline, this refusal to get swept up in the drama of the turnaround, is a crucial component of long-term risk management and capital preservation. It is the conscious choice to play a game that is easy to win, rather than one that is hard. The ultimate purpose of this entire mental framework is to generate tangible financial results. The principle of buying a business an idiot can run isn't just an elegant intellectual exercise. It is a ruthlessly effective strategy for building wealth, and its impact can be seen directly on the financial statements of the companies you choose and the long-term performance of your own portfolio. The direct financial connection is where the rubber meets the road, translating a qualitative concept, the moat, into quantifiable, undeniable financial strength. Let's start with the income statement. A company with a deep, durable moat exhibits consistently high and stable gross profit margins. Look at a company like Moody's, the credit rating agency. It has a massive moat, rooted in regulation and reputation, an oligopoly. For years, its gross margins have hovered around a staggering 70%. This is the financial signature of pricing power. They can charge high prices for their service because their customers have few, if any, other choices. Now compare that to a company in a fiercely competitive industry, like an airline. An airline's gross margins are razor-thin and volatile, subject to fuel costs, price wars, and economic cycles. Running an airline is hard. It requires brilliant management just to break even. Running Moody's is, by comparison, far easier. The business structure itself does the heavy lifting, converting revenue into profit at an incredible rate. Further down the income statement, you'll find high net profit margins and, most importantly, a high return on tangible equity, ROTE. A truly wonderful business doesn't need a lot of physical assets, factories, machinery, inventory, to generate its profits. See's Candies, after the initial purchase, required very little capital to grow. Its primary asset was the brand in the customer's head. This is why Buffett loves businesses built on intangible assets. They are incredibly capital light. They can grow without consuming vast amounts of cash. This results in a sky-high return on the actual capital invested in the business. A business that consistently generates a ROTE above 20 or 30% is likely a fantastic business. A business that struggles to earn its cost of capital is a terrible one, no matter who is running it. Now, let's turn to the balance sheet. A great business often has a negative cash conversion cycle. This sounds complex, but it's a simple and beautiful concept. It means the company gets paid by its customers before it has to pay its suppliers. Amazon is a master of this. You pay for a product on their website today, but Amazon may not have to pay its supplier for that product for 30, 60, or even 90 days. During that time, they have your money, an interest-free loan from their customers and suppliers, which they can use to fund their operations and growth. This is a powerful financial float, a source of free capital that strengthens the balance sheet and reduces the need for debt. Contrast this with a heavy manufacturing company that has to spend millions on raw materials and labor, then wait months to sell the finished product, and even longer to collect the cash from its customers. This is a cash-hungry, difficult business model. Finally, the most important financial statement for an investor, the statement of cash flows. An idiot-proof business is a free cash flow machine. Free cash flow is the lifeblood of any company. It's the cash left over after all expenses and necessary capital expenditures have been paid. This is the money that can be used to reward shareholders. A company with a strong moat will gush free cash flow year after year with remarkable consistency. This consistency is the key to portfolio growth and financial freedom. It allows for a predictable stream of dividends and share buybacks, which turbocharge the compounding process. When you focus your capital on businesses with these financial characteristics, high margins, high returns on capital, negative cash conversion cycles, and abundant free cash flow, you are systematically tilting the odds in your favor. You are ensuring that your investment is not just protected by a story or a CEO, but by the cold, hard mathematical reality of a superior business model. This is the ultimate financial transformation. Your portfolio becomes a collection of fortresses, each with its own internal, self-sustaining economic engine, reliably churning out cash for you, its owner, regardless of who has their hand on the tiller. The second great pillar of this philosophy requires us to directly confront our own biases. We must understand and dismantle the fallacy of the savior CEO. This is more than just avoiding turnaround stories. It's a deep-seated psychological recalibration. We are wired to follow leaders, to believe in charismatic individuals, and to attribute success and failure to the person at the top. The stock market amplifies this tendency into a dangerous and expensive cult of personality. Over-investing in companies that depend on a single superstar CEO is one of the most common and catastrophic mistakes a retail investor can make. To understand the peril, we need only look at the history of Berkshire Hathaway itself, but not the triumphant story of its success. We must look at the failure that gave the company its name. In the 1960s, Warren Buffett, then a young, confident hedge fund manager, began buying shares in a struggling New England textile company called Berkshire Hathaway. It was a classic cigar butt investment, a terrible business trading at a statistically cheap price. He thought his own brilliance as a manager and capital allocator could turn it around. He was wrong. The foundational anecdote here is not one of success, but of a decade-long, painful education. Buffett poured money and time into the textile mill. He hired new managers, bought more efficient looms, and tried every trick in the book to make the business competitive. But he was fighting an unstoppable economic tide. The entire American textile industry was dying, facing overwhelming competition from low-cost producers overseas. No matter how intelligently he managed the company, the fundamental economics of the business were abysmal. It was a boat with a massive, irreparable leak. Buffett was the most brilliant captain in the world, but he was spending all his energy bailing water instead of sailing. He later described this decision as his, quote, $200 billion mistake. Not because of the money he lost directly in the mills, which he eventually had to shut down, but because of the immense opportunity cost. For nearly 2 decades, capital that could have been invested in wonderful businesses like See's Candies or the Washington Post was instead trapped in a quagmire, earning pathetic returns. This experience forged his core principle in the crucible of failure. It taught him the most important lesson of his career. It is far better to be in a wonderful business with a fair manager than a terrible business with a brilliant manager. The quality of the business, the horse, is the primary driver of long-term returns, not the skill of the manager, the jockey. The textile mill had no moat. Its only competitive advantage was price, and on that front, it could not win against foreign competition. Any idiot could run it into the ground, and even a certified genius like Warren Buffett couldn't make it thrive. This painful, multi-year struggle inoculated him against the allure of the turnaround. He learned firsthand that his own time and intellect were finite resources. Wasting them on trying to fix a broken enterprise was a fool's errand. His true genius was not in managing businesses, but in identifying and buying wonderful businesses that didn't need him. This shift in perspective is what allowed him to transition from a good investor to the greatest investor in history. He stopped trying to be the savior CEO and started focusing exclusively on buying businesses that needed no saving. For any investor looking to build a resilient portfolio, this story is a vital warning. It demonstrates that even the best and brightest can be humbled by the brutal economics of a bad business. The reason so many of us fall into the trap of betting on a savior CEO lies deep within our cognitive architecture. The underlying psychological principle is a powerful 1-2 punch of the authority bias and the narrative fallacy. The authority bias is our tendency to attribute greater accuracy and importance to the opinion of an authority figure. In the world of business, the CEO is the ultimate authority. They are on the cover of magazines, they give compelling speeches at conferences, they are presented as visionaries with a unique insight into the future. When a charismatic CEO like Elon Musk or the late Steve Jobs lays out a bold vision, our critical thinking faculties can be short-circuited. We are wired to trust the leader of the tribe. We defer to their expertise, often without rigorously questioning the underlying assumptions of their plan. This bias is amplified by the financial media, which creates and perpetuates these larger-than-life personas. They are not just executives, they are gurus, mavericks, and titans of industry. This language elevates them from mere mortals to figures of almost mythical capability, making it psychologically difficult to bet against them. When we invest based on a CEO's reputation, we are often not performing business analysis, we are engaging in a form of hero worship. The second cognitive trap, the narrative fallacy, was popularized by Nassim Nicholas Taleb. It describes our tendency to prefer stories over facts, to create and believe coherent, simple narratives to explain complex and random events. The turnaround story is the perfect example. It's a classic 3-act drama. Act 1. The once great company falls on hard times. Act 2. The brave new CEO arrives to battle the forces of incompetence and decay. Act 3. The company is reborn, triumphant, and investors are richly rewarded. This is a story we understand. It's the plot of countless movies and books. It feels right. The problem is that reality is far messier and more random than a clean narrative. A company's failure or success is the result of thousands of interlocking factors: competitive pressures, technological shifts, macroeconomic trends, supply chain disruptions, and pure luck. But our brains crave a simple cause and effect story, so we latch on to the most visible and compelling agent, the CEO. We tell ourselves, the company succeeded because of the brilliant CEO, or it will succeed because this new CEO is a genius. This allows us to create a sense of order and predictability in an inherently chaotic system. The danger of the narrative fallacy is that it causes us to overestimate the impact of leadership and underestimate the impact of the business environment and random chance. It leads to overconfidence and a failure to properly assess risk. When you invest in a turnaround, you are not just buying a stock, you are buying a story. And when the story falls apart, when the CEO's plan doesn't work, when a competitor makes an unexpected move, when the economy turns, the investment thesis evaporates. Buffett's approach is a powerful antidote to both of these biases. By focusing on the business first, he is deliberately ignoring the siren song of authority and narrative. He is asking a much more robust question. Is this business so structurally sound that it will succeed despite its leadership, not because of it? This framework forces a shift from storytelling to systems thinking. It is an act of intellectual humility, an admission that we cannot predict the future or the performance of a single individual. All we can do is stack the odds in our favor by investing in businesses whose success is as close to a sure thing as possible. To protect our portfolios from the savior CEO fallacy, we need an applied mental model, a practical blueprint for de-risking the human element in our investments. This isn't about ignoring management entirely, but about reprioritizing our analysis to focus on structural resilience over individual brilliance. This blueprint can be called the Leadership Redundancy Protocol, and it consists of 3 key analytical filters. The first filter is the bus test. It's a slightly morbid but highly effective thought experiment. Ask yourself this question. If the CEO and the entire senior management team were to get hit by a bus tomorrow, what would happen to the business over the next 5 years? For a company that is heavily reliant on a visionary founder, like a Tesla or a pre-succession Apple, the answer is deeply unsettling. The stock would likely plummet, and the company's future direction would be thrown into chaos. The business is fragile because its strategic vision and innovative engine reside in the minds of a few key people. Now, apply the bus test to a company like Coca-Cola, Johnson & Johnson, or Procter & Gamble. While the loss of its leadership would be a tragedy and a short-term disruption, the fundamental business would almost certainly be fine. The global distribution networks would still exist. The brands which have been built over a century would still reside in the minds of billions of consumers. The daily operations of bottling plants and shipping trucks would continue. The business has a deep bench of management, a well-established culture, and a business model that runs on deeply ingrained processes and consumer habits. The business itself is the system. The CEO is merely a steward of that system. Your goal as an investor is to find companies that pass the bus test with flying colors. The second filter is the key person risk audit. This involves moving from a thought experiment to a concrete investigation. Read the company's 10-K, its official annual report filed with the SEC. In the Risk Factors section, companies are required to disclose significant risks to their business. Look for any language that mentions a dependence on a single founder, CEO, or a small group of key employees. If the company itself is telling you that its operations would be materially and adversely affected by the loss of a specific individual, you should take that warning very seriously. This is a direct admission of a single point of failure. Contrast this with a company whose risks are more related to competition, regulation, or economic conditions. While still risks, these are systemic factors, not fragile dependencies on a single human being. Furthermore, investigate the company's succession plan. Is it clearly articulated? Is there a history of promoting from within, indicating a strong and deep management culture? A company like General Electric, for all its later struggles, was famous for being a CEO factory, with a rigorous and well-defined process for developing internal leaders. This is a sign of a robust organization, not just a charismatic frontman. The third filter is the incentive structure analysis. You must understand how the CEO and senior management are being paid. Are their bonuses tied to short-term metrics, like quarterly earnings per share or the daily stock price? This can encourage reckless, short-sighted behavior and financial engineering to hit a number, rather than long-term value creation. Or are their incentives tied to long-term performance metrics, like return on invested capital or growth in intrinsic business value over a 3 to 5 year period? Are they significant shareholders themselves, having purchased shares with their own money, rather than just being granted options? You want to see a management team whose financial interests are deeply and genuinely aligned with the long-term interests of the shareholders. A CEO who is paid like a long-term owner will act like one. A CEO who is paid like a short-term trader will act accordingly. By systematically applying the bus test, the key person risk audit, and the incentive structure analysis, you can build a portfolio that is fundamentally more resilient. You are actively seeking to minimize the impact of any single individual on your investment returns. This is the essence of professional risk management. It's the sober, disciplined approach that separates sustainable wealth creation from speculative gambling on personalities. It ensures your financial freedom is built on a foundation of durable businesses, not the shifting sands of human genius. To fully grasp the power of this protocol, we must once again walk the path of the 99% and examine the devastating consequences of ignoring it. The antithesis here is the cult of the visionary, an investment strategy that actively seeks out and concentrates capital in companies led by messianic figures. This approach is not just risky, it is a ticking time bomb, and the financial landscape is littered with the wreckage of its failures. The 99% investor is drawn to the story of the lone genius, the rebel who is changing the world. They see a figure like Adam Neumann at WeWork, Elizabeth Holmes at Theranos, or even the more legitimate but still intensely personality-driven leadership of someone like Jack Welch at General Electric. They don't buy the stock. They join the movement. Their investment is an expression of their belief in the leader's vision. The first catastrophic failure of this approach is the complete abdication of critical analysis. When you buy into the cult of the visionary, you start to interpret all data through the lens of that vision. Skeptical questions are dismissed as a lack of faith. Negative news is brushed aside as term noise, or the whining of naysayers who just don't get it. Financial metrics become secondary to the narrative. WeWork was a classic example. The company was, for all intents and purposes, a real estate leasing company. It signed long-term leases on office space and then sublet it on a short-term basis. This is a simple, cyclical, and capital-intensive business model. But Adam Neumann, a master storyteller, framed it as a technology company, a spiritual movement, a community that was elevating the world's consciousness. Investors, mesmerized by his charisma, ignored the company's staggering losses and absurd valuation. They weren't investing in a real estate company, they were investing in Neumann's vision. When the narrative finally collided with financial reality during its failed IPO attempt, the valuation collapsed by over 90%, wiping out billions in investor capital. The second failure is the king has no clothes syndrome. Companies led by dominant visionary founders often develop a corporate culture that stifles dissent. No one wants to be the one to tell the genius that their new idea is flawed. This creates an echo chamber where bad decisions can go unchecked and escalate into disasters. The fall of Enron under Ken Lay and Jeff Skilling was, in part, a story of a culture where questioning the leadership was career suicide. Elizabeth Holmes's Theranos was an extreme case, where a culture of fear and secrecy allowed a massive fraud to perpetuate for years, simply because employees were too intimidated to challenge the visionary's claims. An investor who bets on the visionary is also betting on the unseen and unknowable corporate culture that surrounds them. The third, and perhaps most common failure, is the successor's dilemma. Even if the visionary CEO is genuinely brilliant and successful, they create a massive problem for the company's future. Who can possibly fill those shoes? When a company's identity and strategy are so intertwined with one person, any successor is set up to fail. They are either criticized for not being the original founder, or they try to imitate the founder's style and fail. Look at the struggles of General Electric after the legendary Jack Welch retired. His hand-picked successor, Jeff Immelt, presided over a decade of stagnation and eventual collapse. Immelt was a capable executive, but the complex empire Welch had built and the sky-high expectations he had set proved impossible to manage. The stock became dead money for over a decade, a prime example of how even a successful visionary can leave a legacy that poisons the well for future investors. The investor who chases visionaries is playing a game with a hidden expiration date. They might enjoy a spectacular ride-up, but they are constantly exposed to the risk of the narrative breaking, the culture souring, or the inevitable departure of the leader. The portfolio growth is built on a foundation of sand, The disciplined investor, following the leadership redundancy protocol, consciously avoids these situations. They trade the intoxicating thrill of the visionary story for the quiet, relentless compounding of a business that runs on systems, brands, and processes. A business that is built to outlast any single individual. The financial consequences of falling for the savior CEO fallacy are brutal and direct. The difference between investing in a business dependent on a genius and one that an idiot can run manifests starkly across every dimension of your financial life, from the volatility of your portfolio to your ultimate rate of wealth compounding. Let's connect this principle directly to the numbers. The most immediate financial impact is on portfolio volatility. Companies led by charismatic, visionary CEOs often have incredibly volatile stock prices. Their value is tied not to their stable earnings, but to the market's perception of the CEO's next move. Every tweet, every interview, every product announcement can send the stock soaring or plummeting. This creates a high-stress investment experience, one that is more akin to gambling on a roulette wheel than engaging in prudent asset allocation. An investor in this type of company is constantly whipsawed by market sentiment, tempted to buy at the peaks of euphoria and sell at the troughs of despair. This emotional roller coaster is a direct enemy of long-term investing. In contrast, a portfolio of idiot-proof businesses tends to exhibit much lower volatility. A company like Johnson & Johnson or Waste Management doesn't live and die by its CEO's pronouncements. Its value is derived from the steady, predictable cash flows generated by its entrenched business operations. Their stock prices tend to grind upwards over time, with fewer heart-stopping drops. This stability is not just good for your peace of mind, it's mathematically superior for compounding wealth. Lower volatility allows you to stay invested through market cycles, capturing the full benefit of long-term growth without being shaken out by fear. The second major financial connection is risk management, specifically the risk of a permanent loss of capital. A bet on a turnaround story or a visionary CEO is a highly concentrated binary bet. If the turnaround fails or the visionary leaves, the investment thesis is completely broken. The stock may never recover its former value. This is how you suffer a permanent loss. You haven't just lost money, you've lost the time that money could have been compounding elsewhere. Now consider the financial profile of an idiot-proof business. Because its success is based on a durable moat, the risk of permanent capital loss is dramatically lower. If a company like Coca-Cola hires a subpar CEO, the business might stagnate for a few years. Profits might dip slightly, but it is almost inconceivable that the company would go bankrupt. The global brand and distribution system provide an enormous margin of safety. The business's intrinsic value is a hard floor that protects your capital. Eventually, the board will replace the subpar CEO, and the powerful business will resume its upward march. You might suffer a period of underperformance, but the core asset remains intact. This is the essence of Buffett's rule number 1: never lose money. It's not about avoiding any stock market declines. It's about avoiding investments where the entire thesis can evaporate overnight, leading to a permanent impairment of your capital. Finally, the most profound financial impact is on the long-term rate of return. The quiet, boring, idiot-proof businesses are often the market's greatest compounders. Because they are so profitable and require so little capital, they generate enormous amounts of free cash flow. This cash is then returned to shareholders through dividends and buybacks. A steady dividend provides a reliable stream of income, while share buybacks increase your ownership stake in the business and boost earnings per share. This process, repeated year after year, decade after decade, is the simple, unglamorous engine of wealth creation. The visionary-led company, on the other hand, is often a cash furnace. It must constantly reinvest every dollar it earns, and often much more, raised from shareholders, into speculative new projects to fulfill its grand vision. There is often little to no cash left over for shareholders. The only way an investor makes money is if the stock price goes up. A bet on hope and future growth not on current, tangible cash returns. By focusing on businesses that can be run by anyone, you are aligning yourself with the most powerful force in finance. The relentless, automatic, and unemotional compounding of capital returned to its owners. We now arrive at our third pillar, which bridges the gap between the qualitative idea of a moat and the quantitative reality of a great investment. This pillar is the quantitative filter, identifying idiot-proof financials. A great story about a brand or a visionary CEO can be captivating, but stories can be misleading. Numbers, when properly understood, do not lie. An idiot-proof business leaves a distinct set of fingerprints all over its financial statements. Learning to read these signals is what separates a professional investor from an amateur speculator. It's how you verify the existence of a moat, using the universal language of business, accounting. The foundational anecdote for this pillar takes us to one of the most frightening moments in the history of American finance, the Salad Oil Scandal of 1963. The protagonist is not a company, but a scoundrel named Tino DeAngelis. DeAngelis was a commodities trader who realized he could get loans by using his vast inventory of soybean and cottonseed oil as collateral. The only problem was, the inventory didn't exist. He filled his storage tanks mostly with water, with only a thin layer of oil on top. Inspectors would see the oil, approve the inventory, and the banks would issue the loans. It was a massive, brazen fraud. One of his biggest creditors was American Express, which had a warehousing division that certified Tino's inventory. When the fraud was discovered, Tino's company collapsed, and it looked like American Express was on the hook for over $60 million in losses, a catastrophic sum at the time that threatened to wipe out the company's entire net worth. Wall Street panicked. The narrative was simple and terrifying. American Express, a symbol of trust and financial probity, had been duped. Its reputation was shattered. How could anyone ever trust their travelers' checks or credit cards again? The stock plummeted by nearly 50%. Investors, driven by fear and a terrifying story, dumped their shares indiscriminately. But a young Warren Buffett, running his small investment partnership in Omaha, decided to do something radical. He decided to ignore the story and look at the numbers and the underlying business reality. He didn't just read the financial reports. He conducted his own on-the-ground research. He went to restaurants and travel agencies. He stood at airport check-in counters. He observed human behavior. He saw that despite the scandal dominating the headlines, ordinary people and businesses were not stopping their use of American Express products. Customers were still confidently buying travelers' checks. Businesses were still proudly displaying the American Express cards welcomed here sign. The scandal, it turned out, was confined to the obscure warehousing division. The core businesses, travelers' checks and the charge card, had moats that were completely unaffected. The traveler's check had a massive network effect and a brand built on a century of trust. The charge card had a powerful brand associated with prestige and a closed-loop network of affluent cardholders and high-end merchants. These businesses were so strong, so embedded in the commercial fabric of the country, that even a company-threatening scandal couldn't break the consumer habit. Buffett realized that the market was confusing a one-time, albeit massive, loss in a minor division with a fatal blow to the entire enterprise. He saw that the company's underlying earning power from its core operations was immense and intact. The numbers told a story of a business that was gushing cash, a business that could easily earn its way out of this financial hole in just a few years. While Wall Street was panicking about the narrative, Buffett was calmly calculating the intrinsic value based on the durable economics of the real business. He invested 40% of his partnership's capital into American Express stock. Within 2 years, the stock had tripled, and his investment became one of the foundational legends of value investing. This anecdote is the ultimate lesson in quantitative filtering. It teaches us that the market can be swept away by fear and narrative, creating incredible opportunities for the investor who stays rational and focuses on the underlying financial strength and durable competitive advantages of the business itself. The psychological principle that allowed Warren Buffett to make a fortune while everyone else was panicking is the ability to overcome what is known as base rate neglect. Base rate neglect is a cognitive bias where people tend to ignore general statistical information, the base rate, in favor of specific, narrative-driven information. In the case of the salad oil scandal, the specific, dramatic narrative was, American Express is caught in a massive fraud and is going bankrupt. The fear, the headlines, and the drama were vivid and emotionally compelling. The base rate information, however, told a very different story. The base rate question would be, historically, what percentage of dominant consumer financial brands have been permanently destroyed by a scandal in a non-core division? The answer is very, very low. Strong consumer habits and powerful brands have an incredible amount of inertia. Think of major banks that have survived massive trading scandals, or food companies that have survived product recalls. If the core value proposition to the consumer remains intact, the business usually recovers. The average investor in 1963 fell victim to base rate neglect. They were completely consumed by the specific story of the scandal. They imagined a world where everyone suddenly cut up their American Express cards in disgust. They extrapolated the specific event into a universal catastrophe for the company. They ignored the statistical reality that consumer habits are incredibly sticky and that powerful brands are resilient. Buffett, on the other hand, was a master of base rate thinking. His on-the-ground research was a way of testing the base rate. By observing that people were still using the cards and checks, he was confirming that the scandal was not, in fact, altering the fundamental consumer behavior that drove the company's profits. He was able to emotionally detach from the terrifying narrative and focus on the objective, statistical reality of the business's earning power. This mental skill is crucial for any investor aiming for long-term portfolio growth. The market is constantly throwing dramatic narratives at you. A company misses its quarterly earnings by a penny and the stock drops 20%. A competitor announces a new product and the narrative becomes, "The king is dead." A negative news article is published and panic ensues. In each case, the investor who reacts to the story is likely to make a poor, emotionally driven decision. The investor who practices base rate thinking will ask a different set of questions. What is the base rate of success for companies in this industry with these margins and this return on capital? Historically, how have strong brands responded to this type of competitive threat? What percentage of the time does a single earnings miss signal a permanent deterioration of the business? This approach forces you to zoom out from the specific, anxiety-inducing event and place it in a broader, more rational context. It is a powerful tool for fighting another related bias, availability heuristic. This is our tendency to overestimate the likelihood of events that are more recent, more frequent, and more emotionally charged in our memory. The scandal was available. It was on the front page of every newspaper. The quiet, boring reality of millions of daily profitable transactions was not. By focusing on the quantitative fingerprints of a great business, the consistent margins, the high returns on capital, the durable cash flows, you are building a defense against the emotional volatility of the market's narratives. You are anchoring your decision-making in the stable base rate of a superior business model, not the shifting sands of the day's headlines. To transform this psychological insight into a usable tool, we need an applied mental model for financial analysis. This is not about becoming a certified public accountant, but about developing a financial literacy that allows you to spot the key indicators of an idiot-proof business. We will call this blueprint the Financial Fortress Framework, and it consists of 3 core components: profitability ratios, capital efficiency metrics, and cash flow analysis. First, let's look at profitability ratios. These tell you how good a company is at turning revenue into actual profit. The first number to look at is the gross profit margin, gross profit/revenue. As we discussed, a consistently high gross margin, above 40% is a good starting point, is often the first sign of a competitive advantage. It shows the company has pricing power. Next, look at the net profit margin, net income/revenue. This tells you what's left for shareholders after all expenses, including taxes and interest, are paid. A consistently high net margin, above 10 to 15%, indicates an efficient and profitable operation. But the most important thing is not the absolute number, but the 10 consistency. Look at these margins over a 10-year period. Are they stable or even increasing? Or are they volatile and unpredictable? A financial fortress has stable, predictable profitability. An airline might have a high profit margin one year and a negative one the next. That's a sign of a difficult cyclical business. The second component is capital efficiency metrics. It's not enough for a business to be profitable. It must be profitable without requiring enormous amounts of capital. The king of these metrics is return on invested capital, ROIC. ROIC measures how much profit a company generates for every dollar of capital invested in the business, both debt and equity. A company that can consistently generate an ROIC above 15% is likely a very good business. It means for every dollar the management team invests, they are creating at least 15 cents of profit annually. This is the ultimate measure of managerial effectiveness and business quality. A company that struggles to earn an ROIC higher than its cost of capital is, in effect, destroying value with every dollar it reinvests. Another related metric is return on equity, ROE, which measures profitability relative to shareholders' equity. While useful, be cautious. A company can juice its ROE by taking on a lot of debt. That's why ROIC, which includes debt in its calculation, is often a more honest measure of a business's underlying quality. The third and most critical component is cash flow analysis. As the saying goes, revenue is vanity, profit is sanity, but cash is reality. A company can manipulate its reported earnings through various accounting tricks, but it's much harder to fake cash. You want to look at the statement of cash flows. Specifically, you want to find the free cash flow, FCF. This is the cash generated by the business's operations, minus the cash needed for capital expenditures. This is the true owner's earnings. This is the cash that can be used to pay dividends, buy back stock, or make acquisitions. A financial fortress is a free cash flow geyser. Look for companies that generate a consistently high and growing stream of free cash flow. A good metric to use is the free cash flow margin, free cash flow/revenue. A company with a consistent FCF margin above 10% is typically a strong cash generator. Furthermore, compare the company's reported net income to its free cash flow over a long period. In a healthy, honest company, these two numbers should track each other fairly closely. If a company consistently reports high profits but generates little or no free cash flow, that is a massive red flag. It may be a sign of aggressive accounting or a fundamentally broken business model. By systematically examining these three areas, profitability, capital efficiency, and cash flow, you can build a quantitative picture of a business's moat. This framework forces you to move beyond the stories and focus on the facts. It is the core skill for any investor serious about long-term stock picking and beating the S&P 500. Let's once again walk the path of the 99% to understand the antithesis of this disciplined, quantitative approach. The common mistake is what can be called story stock investing. This is an approach where the narrative about a company's future potential completely overshadows its current financial reality. It's an investment strategy fueled by hope, hype, and a deliberate disregard for the numbers that define a business. The story stock investor is often found in the most speculative corners of the market: pre-profit biotechnology companies, concept stage technology firms, or any business promising to disrupt a major industry. The story is always compelling. This company will cure cancer. This company will create artificial general intelligence. This company will revolutionize transportation. The potential is, in theory, limitless. The problem is that the financials are often horrendous. A classic story stock has several distinguishing characteristics. First, it has negative profitability, not just for a quarter, but for years on end. The income statement is a sea of red ink. The company justifies this by saying they are investing for growth. While this can be legitimate for a short period, a business that cannot demonstrate a clear path to profitability is not a business. It's a science project funded by shareholder capital. Second, these companies are perpetually burning cash. Their statement of cash flow shows a massive negative figure for cash from operations. They are not self-funding. To survive, they must constantly raise new capital by issuing more stock, diluting existing shareholders, or taking on more debt. The story stock investor is not a part owner of a profitable enterprise. They are a source of funding for a perpetual cash furnace. Their hope is that someone else, a greater fool, will come along and buy their shares at a higher price before the cash runs out. This is not investing, it's speculation. Third, the balance sheet is often weak and precarious. With no profits and negative cash flow, the company's cash balance is always dwindling. The primary activity of the management team is not running a business, but raising capital. The company is always just a few quarters away from a potential liquidity crisis. This creates a fragile, high-risk situation where any piece of bad news, a delayed product launch, a failed clinical trial, a competitor's success, can send the stock price into a death spiral. The psychological trap here is immense. The story is so exciting, and the potential upside seems so large that the investor succumbs to a severe case of confirmation bias. They actively seek out information that confirms the narrative: positive press releases, bullish analyst reports, enthusiastic online forums, while dismissing the mountain of negative financial data as irrelevant short-term noise. They tell themselves that traditional valuation metrics don't apply to a company that is changing the world. This is a dangerous delusion. While a tiny fraction of these story stocks do go on to become the next Amazon or Google, the vast majority end in failure. The base rate of success is infinitesimally small. For every winner, there are 1,000 that go to zero. The investor who fills their portfolio with story stocks is essentially buying a portfolio of lottery tickets. They are abandoning the proven principles of business analysis for the high-stakes gamble of narrative-driven speculation. The disciplined, quantitative investor understands that a great story is only valuable if it is supported by great numbers. They let the financial fortress framework guide their capital allocation, ensuring that every investment is backed by the reality of current profitability and cash flow, not just the promise of a glorious future. The direct financial connection between a quantitative filtering approach and your wealth is profound. Choosing businesses with fortress-like financials fundamentally alters the risk and return profile of your portfolio, creating a much smoother and more reliable path to financial freedom. Let's quantify this impact. First, consider the impact on dividend income and share buybacks. A company that gushes free cash flow has the financial firepower to consistently reward its shareholders. A history of steadily increasing dividends is one of the clearest signs of a durable, idiot-proof business. This dividend stream provides a tangible return on your investment, regardless of the stock market's daily whims. It's real cash deposited into your account. During a bear market, this income can be a powerful psychological anchor, and it can be reinvested at lower prices, accelerating your compounding. Furthermore, these companies use their excess cash to buy back their own shares. A share buyback is a tax-efficient way to return capital to shareholders. When a company reduces its number of shares outstanding, your ownership percentage of the company increases without you having to do anything. This automatically boosts earnings per share, which tends to drive the stock price up over the long term. A portfolio filled with these cash-returning machines becomes a powerful, semi-automated wealth-building engine. In contrast, a portfolio of story stocks provides no such tangible returns. It is a waiting game, a bet that the stock price will go up. It pays no dividends and often dilutes your ownership by issuing more shares. The entire burden of your return is on capital appreciation, which is far less certain. Second, think about the effect on valuation and your margin of safety. Because idiot-proof businesses have a long history of predictable earnings and cash flows, it is much easier to estimate their intrinsic value. You can use simple valuation models like a discounted cash flow (DCF) analysis with a higher degree of confidence. This allows you to be patient and wait for the market to offer you a price that is at a significant discount to that intrinsic value. This discount is your margin of safety, the financial cushion that protects you if your analysis is slightly wrong or if the company faces unexpected headwinds. It is the cornerstone of intelligent capital preservation. Story stocks, with their lack of profits and unpredictable futures, are nearly impossible to value rationally. Any valuation is simply a guess about a distant and uncertain future. There is no anchor in current reality. As a result, there is no way to calculate a reliable margin of safety. You are buying on hope, and if that hope fades, there is no floor of intrinsic value to catch the falling stock price. Finally, consider the impact on long-term, tax-efficient compounding. The best investment strategy is often to buy a wonderful, idiot-proof business at a fair price, and then do nothing for a very long time. Because the business is so durable, you don't need to constantly monitor it or trade in and out of it. This long-term holding period allows your investment to compound uninterrupted, and it dramatically reduces your tax burden. You only pay capital gains tax when you sell, allowing your entire investment to keep working for you year after year. This is how real, generational wealth is built. The owner of story stocks is forced into a much shorter-term mindset. The high risk and volatility of the stocks often lead to more frequent trading, trying to time the peaks and troughs. This not only racks up transaction costs, but also generates short-term capital gains, which are taxed at a much higher rate. It is a financially inefficient and stressful way to manage a portfolio. By committing to a quantitative filter, you are not just choosing better companies, you are choosing a better financial path. You are opting for a strategy of tangible cash returns, a strong margin of safety, and tax-efficient, long-term compounding. You are choosing the slow, steady, and reliable road to wealth over the fast, treacherous, and often disastrous path of speculation.